Hi, and welcome to Barnes Dennig Ask the Experts. I'm Kat Jenkins, Marketing Director at Barnes Dennig, and today we're talking year-end tax planning with our experienced tax team. Manager Mark Hammett is going to be sharing ideas, strategies, and insights on tax planning with Dan Schlachter, who is one of our experienced tax associates. So Dan, I know you have a lot of great questions for Mark, and so I am going to hand it off to you and we can get started.
Thanks, Kat. Hi, Mark. Thanks for joining us.
Hey, Dan. Thanks for setting this up. Excited to talk about some year-end strategies with you.
Me too. Obviously, a crazy 2020 tax year is finally coming to an end. And now with the 2019 tax season behind us, we're looking forward to 2020 tax year-end planning strategies. Right off the bat, do you have any general tax saving strategies for the end of the year here?
Yeah, well, there's a lot you can do before year-end. One size doesn't fit all for tax strategies. Obviously, if you're a business owner and a W-2 employee, your tax strategies are going to be completely different. If you are a young tax professional versus an older taxpayer, your strategy is going to be completely different. If you're a high-income earner and a low-income earner, again, strategy is going to be completely different. So it's not one size fits all when it comes to year-end tax strategies. But there are some things we look at Barnes that fits a lot of taxpayers. And just some things off the top of your head. Roth conversions, number one. If you're in a low-income tax year, does it make sense to do a Roth conversion and pull that income into 2020? Same thing with retirement accounts. Are you contributing as much as you can to a retirement account? Are you looking at traditional IRAs versus Roth IRAs, traditional 401ks versus Roth 401ks? So those are kind of some of the things you can look at from a cash saving perspective. If you're eligible for an HSA plan, if you have a high deductible plan at work, are you eligible and contributing to an HSA? Are you a charitably inclined taxpayer? There's a lot of tax strategies surrounding charitable contributions and not just cash contributions. Some other items off the top of my head, if you have some unrealized gains in your investment portfolio, does it make sense to pull the trigger on some of those unrealized gains and pull them into 2020? Likewise, are unrealized losses, would it make sense to pull the trigger on some unrealized losses? And, with the CARES Act this year, RMDs are no longer required for this year, but does it make sense if you're in a low income tax year to pull some of those required minimum distributions into 2020? And then, there's just some general year-end strategies that make sense to think about. Some estate planning, estimated taxes. Are you paying the right estimated taxes, not overpaying? So there's a lot of general strategies out there, just depending on where you fit in your life.
Well, great. It looks like there's a ton of stuff there we can dive into if you don't mind.
Yeah, definitely.
First off the bat, I have an HSA account at work. What are some tax implications of those?
Yeah, so if you have a high deductible plan at work and you're eligible for an HSA, I would strongly encourage it. An HSA acts as another retirement vehicle. So think just like an IRA or a 401k. An HSA actually has triple tax benefits. So if you're a W-2 employee, you'll contribute funds in, and that'll reduce your taxable income. Those funds going into your HSA. They'll also grow in the HSA tax-free, and when you distribute those funds out for qualified medical expenses, those will actually be tax-free as well. So again, kind of triple tax savings. It goes in tax-free, it grows tax-free, and you can distribute it tax-free. And you can also use your HSA, like I said, as a retirement vehicle or an emergency fund. So if you wanted to, you could pay medical expenses out of pocket. So whether it's from your credit card or your checking account, and then a couple years down the road, if you wanted to, you could reimburse yourself through that HSA for those medical expenses you paid out of pocket.
Great. Also, you mentioned Roth IRAs versus regular IRAs. Could you go into a little more detail about that?
Yeah, yep, definitely. So Obviously, if you're in a low income tax year, it might make sense to pull, if you have traditional IRAs out there or traditional 401ks, it might make sense to roll over some of those into a Roth account. You know, in a low income tax year, if you're in a lower bracket, maybe you obviously get taxed on the conversion amount. So maybe it makes sense to roll those over, get taxed in a low income tax year, and then you'll have those funds in a Roth IRA or a Roth 401k, and they'll be able to grow tax-free. So, you know, it's kind of just a thoughtful strategy in a low-income tax year and a good way to hedge against increasing tax rates down the road.
Great. If I did want to make some charitable contributions this year, how can I get the best tax advantage there?
Yeah, yep, definitely. So no going in, married filing joint, is slightly under $25,000 for the standard deduction this year. So if you don't have deductions over that amount, you obviously take the standard deduction this year. And taking a step back, I mentioned the CARES Act before, which was enacted in March with the COVID stimulus bill. It allows non-itemizers this year, so people who take the standard deduction, to get a $300 charitable write-off this year, even though they don't itemize. So I know we've got the United Way campaign going on at Barnes here. If you were to contribute up to $300 to that, you could take that write-off in 2020, even if you were to take the standard deduction. But just going off of charitable contributions, if you did itemize, you know, there's a lot of strategies involving just, instead of giving cash contributions to these organizations. So off the top of my head, the number one thing we suggest to clients is called charitable bunching. So what this does is it lumps 2 years of charitable contributions into 1 year. So for example, say you were going to give to your church in 2020, you give your normal contributions throughout 2020, and then say in December you decided, hey, I want to do this charitable bunching, you would go ahead and give all your 2021 contributions in December. Or, I mean, you could spread it out throughout 2020 if you wanted. But what this does is it allows you to take advantage of 2 years worth of charitable contributions. And then the next year, since you already gave your 2021 and 2020, you would take advantage of the high standard deduction. And then the following year, you know, you would double up again, take advantage of the itemized, and then the following year, do the standard deduction. So that's kind of an example of charitable bunching. Some other ideas, donor advised funds, we suggest a lot. So that allows you to set aside a certain amount of money into a donor advised fund, into this specific fund. You would get the write-off in year one, and then you could take that money sitting in that donor advised fund and distribute it how you see fit, whenever you see fit. But the main idea there is you get the funds, you get the deduction in year one. Two other real quick items. If you had an IRA, you could do a QCD, or a qualified charitable distribution. And what that would do is you would take your IRA distributions and you would distribute it directly to charity. So that would allow you to eliminate that income in 2020. So that IRA distribution wouldn't be pulled into income this year because you're giving it directly to charity. And then kind of a last item there is to donate appreciated stock. So if you had a low cost basis asset sitting in your portfolio, instead of selling that and getting taxed on the capital gains and then turn around and paying that cash to the charity, why don't you just go ahead and directly donate that appreciated stock, get the fair market value deduction, and then you don't pay any capital gains on that sale of stock.
Great, a lot of good stuff there.
Yeah.
Speaking of the unrealized gains, what can you do with that as far as year-end planning?
Yeah, so again, kind of like the Roth conversions, if you're in a low income tax year and you have a lot of unrealized capital gains in your portfolio, maybe it makes sense to pull the trigger and realize some of those gains in the low income tax year. Same thing if you have a lot of unrealized capital losses. You know, if you have a lot of bad investments that didn't recover from the March lows, does it make sense to maybe pull the trigger on some of those unrealized capital losses and offset some capital gains?
Okay, great. As far as the Secures Act and CARES Act you brought up earlier, what are some tax implications there, specifically in regards to retirement income?
Yeah, so the Secures Act, the big thing there, it was enacted in late 2019, it changed the RMD age. So it used to be 70 and a half. The Secures Act changed it to 72. And then kind of twofold here, the CARES Act, which was enacted, like I said, in March of this year, eliminated RMDs for 2020. So you could actually, if you had an RMD, you're required to distribute out of your IRA. You could actually skip it this year because of the CARES Act. But getting back again to if you have a low income tax year, maybe it makes sense to just go ahead and take that RMD, pull it into 2020 if you have a low income tax year, and get taxed in a lower tax bracket.
Now, say my spouse passed away this year, should we be planning to file an estate tax return?
So that's a good question. There's a lot of misconceptions out there. You know, a lot of people say, well, I'm under the lifetime exemption. You know, do I even need to do anything with an estate tax return? There's no way we're going to hit it. So we've been telling a lot of people, go ahead and file that estate return, get the portability, and you're allowed, what that does is it allows the surviving spouse to use any available tax exemptions from their spouse. So, and I know in an election year, the estate taxes are a hot topic. So yes, it's a high limit right now, but maybe that gets cut in half down the road, you know, so who knows? So we always suggest going ahead and filing that estate return, claiming the portability, you know, and getting that unused exemption.
Yep. Before we go, any final cash saving or tax saving strategies for year end?
Well, we briefly touched on estimated taxes. So, you know, not really a tax savings idea, but more of a cash savings idea and keeping money in your pocket longer. So there's something called a safe harbor estimate, which allows you to pay in 100, depending on your income, allows you to pay in 110% of your prior year tax. So say, for example, 2020 was another low income tax year, but you're expecting 2021 to be a blowout year. You wouldn't want to go ahead and pay your 2021 estimates based on 2021. You would want to go ahead and take advantage of the safe harbor, pay in 110% of the low income tax year, hold on to that cash as long as possible, and then true it up when you file your 2021 tax return. You know, it just allows you to hold on to the cash longer instead of, you know, giving it to the government earlier. Another strategy that we've been talking to business owners is the QBI deduction, qualified business income. I'm sure everyone's aware of the 20% deduction on qualified business income. However, a lot of people aren't aware is if taxable income's low, your QBI gets limited. So it gets limited to the lesser of QBI, qualified business income, or taxable income. So if you had outside investments that was bringing your taxable income down, maybe it makes sense, again, to do the Roth conversion, to do your RMD, to do some unrealized gains, to get your taxable income up so you can take advantage of the 20% deduction. Yeah, you know, that's about it, really.
Great. Well, a ton of good stuff you gave us there. And I mean, if you don't have anything else, that'll wrap up our 2020 year-end tax planning video. If you guys have any questions or want some more information, visit our website at barnesdennig.com. And we hope to see you next time on the Ask the Experts series.
Thanks, Dan.
Thanks.